Hey everyone, and welcome to The Explainer. So, if you're a young adult who's just stepping out into your career, honestly, the whole concept of wealth building can feel like this incredibly intimidating giant puzzle. You're trying to figure out your new job, you're trying to navigate your living situation, and somehow, on top of all that, you're supposed to have your entire financial future perfectly mapped out. It's a lot. But don't worry, because today we are going to be your friendly step-by-step guide to completely demystify this whole wealth building thing.
Let me just ask you point blank. What if setting aside just $100 a month, which, let's be real, is basically the equivalent of what you might spend on a few coffee runs or takeout orders each week, could completely alter your financial trajectory? What if this single, small decision you make today determines whether you retire totally financially free or if you end up struggling for the rest of your life? I know, no way, right? It sounds like a massive claim, but I promise you the math absolutely backs it up.
Okay, let's dive into this. We're going to break this overwhelming topic down into 5 highly manageable chapters. The middle-class wealth trap, finding your first $100, the magic of compound interest, the wealth-building mindset, and finally, the snowball effect.
All right, let's kick things off with Chapter 1, the middle-class wealth trap.
It is incredibly common today to have a great college degree, a totally decent paycheck, the latest smartphone, trendy clothes, and yet still feel completely financially vulnerable. In fact, there's a shocking survey out there showing that a majority of Americans literally can't access even $1,000 to cover a sudden emergency. Think about that for a second. More than half the country is trapped in this exhausting cycle of earning and immediately spending, living so close to the edge that just one minor car repair or a sudden medical bill could completely derail their entire lives.
And a big part of the problem is that we are constantly sold this glamorous illusion of wealth. We see Wall Street traders making million-dollar deals, tech billionaires on yachts, or lottery winners hitting the jackpot. But if we pull back the curtain, the reality of how most wealth is made is, well, it's incredibly boring. True wealth is built on consistency, time, and compound growth. It's not about making dramatic headlines. In fact, just by consistently saving $100, you are automatically putting yourself ahead of about 60% of your peers, simply because most people never develop the habit of saving anything at all.
Which brings us right to Chapter 2, finding your first $100. If you're just starting out, you don't just need theory, you need a highly practical blueprint. We need to figure out exactly how to extract that crucial first $100 from your budget without making you feel completely deprived. So here are your foundational steps. Step 1, you've got to examine your fixed costs. Step 2, audit your subscriptions. And Step 3, subtly shift your spending habits. The secret here is realizing that service providers absolutely rely on customer inertia. They literally bank on you being too busy or too lazy to question paying the exact same inflated rates year after year.
So let's rapid-fire a list of quick ways to either cut your monthly expenses or slightly bump up your income. You can spend an afternoon shopping around for better insurance rates. You can call and actually negotiate your cell phone bill. You can finally cancel those unused streaming platforms. Yes, even the one you only keep around for that one sitcom you've already binge-watched 5 times. You can slightly adjust how often you're eating out, or even start a small side hustle. Seriously, dedicating just 1 hour of your weekend to making a few phone calls and auditing your accounts can easily free up that first $100.
Now for the really fun stuff. Chapter 3, the magic of compound interest.
This is the absolute hero of our explainer today. Because the moment you take that $100 and enter the stock market, you start building what's known as a wealth-generating machine. This is the exact pivot point where your money stops being just currency you use to buy stuff and transforms into a completely different beast. It's a financial state where your invested money is literally working for you around the clock, earning returns while you're eating, while you're hanging out with friends, and yes, even while you sleep. You completely change the rules of your money.
Let's actually visualize the math on this so you can see what I mean. On a 10-year investment timeline, if you consistently contribute just $100 a month, you'll have put in $12,000 of your own hard-earned cash. But assuming average, reasonable market returns over that decade, your total portfolio value has actually grown to around $18,000. That is $6,000 of pure passive growth. Now, I know it's super easy to look at that and think, well, $6,000 isn't exactly private island money, which is exactly why so many beginners just give up. But they completely miss the exponential power that is just starting to bubble beneath the surface.
Now, what's really interesting about this is what happens when we stretch that timeline out to a full 40-year career. Over 4 decades, your consistent $100 a month means you've personally contributed less than $50,000 total, $48,000 to be exact. But look at the total value. Your portfolio explodes to over $350,000. Just look at that massive exponential disparity.
On this timeline, more than 85% of your total wealth comes from your money working for you, not from your physical labor. That is huge.
It's honestly an incredible transformation, and it leads to a pretty legendary realization. As the famous quote attributed to Albert Einstein goes, "Compound interest is the eighth wonder of the world." This huge, life-changing leap in wealth, it isn't magic, it isn't getting lucky on a stock pick, it's literally just pure mathematics and having the patience to give your money enough time to compound.
Moving right along to Chapter 4, the Wealth Building Mindset.
Okay, so understanding the math, that's the easy part. The absolute hardest part of this entire journey is trying to overcome a culture that constantly screams at us to buy things for instant gratification. To fight this, successful wealth builders use a crucial strategy called investment automation. Basically, you set up systems that treat your monthly investment exactly like an essential bill. It completely removes the temptation to spend that money elsewhere because you never even see it. You are guaranteeing your financial future by paying yourself first, treating your future wealth with the exact same urgency as your rent. So the crucial point here is the psychological shift you have to make. Next time you're looking at a spontaneous impulse purchase, you have to realize that a $100 dinner today isn't just $100. It is potentially hundreds and hundreds of dollars stolen from your future self. You've got to start valuing the massive exponential growth of your long-term future over the fleeting 5-minute excitement of buying something right now. You have to realize every single dollar has the potential to multiply if you let it.
And that brings us to our final stop. Chapter 5, the Snowball Effect.
This is the ultimate empowerment phase. This is where we see how this small, kind of boring $100 habit scales up powerfully as your career and your income naturally grow over the years. This right here is the exact dividing line between people who stay broke forever and people who actually build wealth. See, the average consumer falls for lifestyle inflation. The second they get a raise, a bonus, or a tax refund, they immediately spend it on an upgraded car or a fancier apartment. But an investor? They practice lifestyle optimization. They take that extra money and channel it straight into their investments, seamlessly turning an initial $100 habit into a $500 or even a $1,000 monthly habit, and they barely even feel the pinch.
Let's look at how this returns curve actually snowballs. In the early years, let's say you get a 10% return on a small $5,000 balance. That's just $500. Honestly, it doesn't feel like much. But as your portfolio grows into your middle years, a 10% return on $50,000 is $5,000. And in the later years, when your account hits $300,000, that exact same 10% return is generating a massive $30,000 in a single year. Your investments scale so incredibly dramatically that eventually your passive income can completely replace your working salary.
So, while everyone else on your social media feed is trying to time the market, chasing the next viral crypto trend, or falling for super risky get-rich-quick schemes, you'll be sitting pretty, relying on small, boring habits. And yes, you'll see market downturns, you'll live through recessions, but over the long haul, these boring, consistent habits provide the ultimate stability. It's a proven fact. This exact, unglamorous method has created more millionaires than literally any other approach in human history.
To wrap things up, I really want to leave you with a provocative thought. What is your very next $100 purchase actually costing your future self? Think about it. Time is the one single asset you can never ever get back. Sure, the best time to start investing was 20 years ago, but the absolute second best time is right now, today. You've got the knowledge, you've seen the blueprint, so what are you waiting for? I highly encourage you to take that very first step today. Thanks for joining us.